If your mortgage rate is anywhere near 6% today, the classic financial advice to invest the difference might actually be costing you your health, your peace of mind, and potentially your future. Society tells you that keeping a 30-year loan to buy index funds is exactly how smart people build wealth. It is the ultimate American milestone, but in this video, I'm going to show you why the math everyone trusts is now fundamentally broken. We are going to look at the hidden costs that spreadsheets completely ignore, the biological toll of carrying heavy debt into your 60s, and most importantly, I am going to give you the exact decision framework to know if you should keep your loan or destroy it immediately. The lie. Let's reverse engineer the advice you've been hearing for the last 20 years. The rule of thumb was always simple. If your mortgage rate is 3% and the S&P 500 returns 8%, you keep the debt. You invest your extra cash, and you effortlessly capture that 5% spread. That was a luxury of the zero interest rate phenomenon. It was a time when money was practically free, and every financial influencer with a smartphone told you that paying off a low-interest loan was for fools. But that era is completely dead. The macroeconomic environment of 2026 has fundamentally altered the mortgage landscape. As of January 2026, Realtor.com and FHFA data show that 21.2% of U.S. mortgages carry interest rates of 6% or higher, officially surpassing the 20.0% of mortgages below 3%. The Great Rate Reversal has happened. A massive cohort of homeowners is now trapped in a rate environment that completely neutralizes the historical benefits of equity investing. More than 1 in 5 American homeowners are operating under a dynamic that actively bleeds their net worth. When you sit down to debate whether to invest or pay off your mortgage, you're usually calculating an absolute fantasy. You assume your income will perfectly track inflation. You assume you won't face a layoff in a softening labor market. But behavioral economics proves that human beings are not spreadsheets. A 2025 update in the Journal of Marketing Research confirms a concept called debt account aversion. Completely eliminating a debt account provides disproportionate psychological relief compared to making partial payments. The human brain registers the number of open obligations, not just the principal balance. Take a Reddit user named Talakafu1. At age 50, anticipating market volatility and deeply uncomfortable with stock market swings, this user liquidated exactly half of their investment portfolio to pay off their mortgage entirely in one lump sum. The financial purists in the comments called it mathematical suicide, but the psychological victory of rejecting optimal math in favor of absolute risk elimination during a period of severe economic uncertainty completely changed their physiological baseline. You are a biological entity operating under massive cognitive load, attempting to service a 360-month contract. The new reality. But here is where the traditional advice gets truly dangerous. The assumption is that once the bank is paid off, your housing costs drop to near zero. You get a free house. But we're only halfway through the equation because you are ignoring the shadow mortgage. Insurify data from March 2026 projects average U.S. home insurance premiums will reach $3,057, marking a 46% climb since 2021. In states like Florida, the 2026 average premium is projected at an astronomical $8,458, while states like Minnesota saw a 34% hike in a single year. Let's break that down. Even without a mortgage, a Florida homeowner pays roughly $704 a month solely for insurance. Add in property taxes that aggressively reappraise every year, baseline maintenance, and utility inflation. This functionally acts as a perpetual, non-amortizing shadow mortgage. You do not own the home. You are renting it from the local tax assessor and the climate risk actuaries. If you don't factor this in, your spreadsheet is lying to you. If you don't pay off your mortgage early, you are forced to pay the bank's principal, the bank's 6% interest, the bloated property tax, and the surging insurance premium all at the exact same time. You essentially created your own personal financing company, except the business loses money every single month. And don't think you can just sell the house if things get tight. The average U.S. monthly mortgage payment increased from $1,924 in 2023 to $2,329 in 2025. The math of paying off a home is complicated by the fact that downsizing or moving resets your interest rate environment. The cost to purchase a $400,000 home requires a $1,200 higher monthly payment today than it did at the pandemic trough. You are effectively trapped in your current property. You cannot outinvest a structural deficit. When your basic carrying costs jump 46% in 5 years, the 8% return on your index fund isn't building wealth. It is barely acting as a life raft. The human cost. Now, no one talks about this next part. We argue endlessly about interest rates, but we ignore what this debt actually does to human tissue over 30 years. If you're asking what happens when you pay off your house, the answer is rarely a sudden burst of luxury vacations. Often, the answer is a sudden surge in physical survival. According to a 2025 study by the Harvard Joint Center for Housing Studies, older adults spend 25% more on out-of-pocket pharmaceuticals after their mortgage is paid off. Think about what that actually means. That 25% wasn't magically generated. That money was always there. The data reveals that older adults actively suppress their healthcare and prescription needs to afford housing payments. Once the mortgage clears, freed capital is immediately diverted to neglected medical care. By following the spreadsheet to the letter, you might be sacrificing your long-term health for short-term financial optimization. Let me tell you about Lauren and Jay from Columbia, South Carolina. Back in the 2000s, Jay was diagnosed with a terminal brain tumor. Most families in this situation drown in medical debt and eventually lose the physical asset to the bank. Instead, they made a radical decision. They ignored the optimal investing advice and aggressively paid off $122,000 in 6 years. Lauren made the final mortgage payment just 4 months after Jay passed away. This wasn't an investment strategy. It was Jay's final act of love. He traded optimum market yields to ensure his wife would never face a foreclosure notice while grieving his death. The U.S. system frequently forces households to choose between biological health and shelter. A 2026 study in JAMA Network Open linked having medical debt to a 44% increased risk of housing instability the following year. And the toll goes far beyond physical health. A 30-year mortgage assumes 30 years of perfect cognitive function, but aging is relentless. Research from the Federal Reserve Bank of New York in 2025 suggests that cognitive decline in one partner causes measurable adverse financial spillover effects on a household's overall debt profile. The cognitive load of managing complex, leveraged debt in your 70s puts your physical asset at severe risk. According to Experian in late 2025, Generation X carries an average of $158,105 in total consumer debt. This generation is entering the final stretch before retirement, carrying unprecedented leverage. They are the sandwich generation, financially supporting aging parents and adult children, all while staring down a massive mortgage balance. When you carry this load, housing instability becomes a clinical trauma event. According to the National League of Cities, in 2024, individuals are significantly more likely to require psychiatric hospitalization in the 2 years following an eviction or foreclosure. Youth aged 6 to 17 facing housing instability have a 57% higher likelihood of experiencing clinical depression. Every time someone tells you to keep a 6% mortgage to blindly invest in the market, they are asking you to carry a psychological weight into your most vulnerable years. The decision framework. So how do you actually navigate this? You know the system is flawed, but you need a solid plan. Before we break down this framework, I need to be clear. I am a researcher and strategist, not your CPA or financial advisor. You must run these numbers with a professional. Most importantly, always maintain a liquid emergency fund of 3 to 6 months living expenses before aggressively allocating capital to illiquid assets like home equity. If you drain your bank account to zero to pay off the house, you fall into the liquidity trap. You become house rich and cash poor, vulnerable to the next $5,000 emergency. Assuming your safety net is in place, here is the exact rulebook for the 2026 economy. Rule number 1, the 6% threshold. If your mortgage rate is 6% or higher, the debate is over. Fidelity analysts in 2026 explicitly noted that if the interest rate on consumer debt is 6% or greater, households should pay down debt before investing additional dollars toward retirement. A guaranteed risk-free return of 6% or 7% by destroying principal is mathematically superior to the volatile taxable returns of the stock market. You attack the debt. Rule number 2, the stability check. If your rate is low, say 3% or 4%, but your income is highly volatile, you prioritize the payoff. Look at modern freelancers, commission-based professionals, and gig economy contractors. Because their income isn't guaranteed for 30 consecutive years, they don't inflate their lifestyle when they have a good month. They use those spikes to buy absolute housing security immediately. They lower their baseline overhead so that a bad quarter doesn't mean losing the house. Rule number 3, the cultural reframe. If the debt is ruining your sleep, causing severe anxiety, or putting stress on your marriage, you pay it off. Period. Research from the PLSA in 2024 found that 29% of divorcees actively waived their rights to pension values due to the immediate financial strain of splitting physical housing assets. Sometimes you have to look outside the American bubble. In Vietnam, there is a core cultural philosophy known as An Cư Lạc Nghiệp. It translates roughly to settle down, then thrive. In this framework, outright home ownership is viewed as the strict prerequisite to career success. American financial advice frames paying off a house as an opportunity cost. Eastern philosophies prioritize physical dirt over stock market yields, viewing outright property ownership as the sole dividing line between surviving and thriving. An observer named Kong Nguyen noted this culture shock perfectly in 2024. Americans view houses as leveraged assets to be traded, while Vietnamese culture views land as absolute safety. An expat returning to Vietnam expressed deep culture shock on a Reddit forum. They realized that in emerging markets, outright property ownership is the sole dividing line between surviving and thriving. Furthermore, by 2060, the AAPI population will surpass 38 million, yet home ownership disparities within Asian subgroups are massive and largely ignored, according to the Urban Institute. If the debt costs you your peace, the interest rate doesn't matter. Rule number 4, the 3% exception. If you are young, your job is hyperstable, you have a massive emergency fund, and you hold a 2.5% or 3% pandemic-era mortgage, you invest the difference. Mathematically, inflation is eating your debt while your investments compound, but you must actually invest the difference. And that is where most people fail. They don't invest the spread, they buy a more expensive car, they upgrade their lifestyle, and they end up with the debt, but without the compounding wealth. Post-payoff traps. If you do choose to pay off your mortgage early, you have to watch out for the final trap, when the forced savings mechanism of a mortgage payment disappears. The sudden influx of discretionary cash is often immediately absorbed by frictionless digital spending. We call it deprivation fatigue. You've sacrificed for years. You've been packing your lunch and skipping vacations for half a decade. Suddenly, you have an extra $2,500 a month. In early 2025, Empower reported a 520% jump in chatbot-assisted shopping usage. Without intentional redirection, the thousands of dollars freed up by your payoff can silently vanish into premium brands, app subscriptions, and frictionless convenience spending. Upgrades are often downgrades in disguise. You destroy the bank's debt only to voluntarily hand your newfound wealth over to tech monopolies and lifestyle creep. You must redirect that freed up cash flow immediately into wealth-building assets, or the sacrifice was for nothing. But if you conquer that creep, the results are profound. Take a magazine editor from 4 States Living magazine. At age 53, she paid off her house, subsequently paid off her car, and realized she was completely debt-free. The immediate psychological shift allowed her to stop operating from fear and start taking creative and social risks for the betterment of her community. Action plan: the digital offense. So what is your next move? You can't just budget your way out of a structural crisis. You can drive older cars to avoid the $554 monthly payment like one dual-income couple did. By actively resisting lifestyle creep, they redirected an extra $1,100 a month toward their principal, paying off a 30-year loan in under 4 years. But you cannot outsave a massive increase in home insurance and high interest rates just by playing defense. Defense is no longer enough. You cannot just cut out lattes to pay off a $400,000 mortgage. You need an income multiplier. If you want to pay off a 30-year loan in under a decade, you need an offensive strategy that scales outside your 9-to-5. That means building leverage. Realtor Sam Dolcine profiled modern homeowners who are utilizing highly volatile digital income like SaaS affiliate marketing, B2B consulting, or digital products to make massive principal payments. They use the asymmetry of the internet to generate outsized zero capital cash flow, and they use that cash to permanently destroy their baseline overhead debt. You aren't waiting 30 years. You are hacking the timeline. The system wants you leveraged. It wants you to carry that psychological weight into your 70s. It is time to make a decision. Let's settle this in the comments right now. Type the word invest if you are keeping your low rate and playing the math. Or type fortress if you are paying it off to buy back your peace of mind. And if you want the exact blueprint on how to build that digital income to attack your principal and buy back your freedom, click the video on the screen right now, where I break down the exact AI and SaaS tools you need to start playing offense. I'll see you there.